You know that dream, right? The one where you buy a single stock, just one, and then you don't look at it for, say, 20 years. And when you finally do, bam, you're set. It's kind of the holy grail of investing. Well, today we're going to dig into an article from the Motley Fool that claims to have found a candidate for exactly that. Let's see what they've got. I mean, that's a pretty big claim, isn't it? The whole set it and forget it thing sounds great, but honestly, what kind of company can you really count on to still be crushing it 2 decades from now? According to this article, the answer boils down to just one single quality. Okay, so what is this secret sauce? What's the number one quality of a stock you can hold on to forever? Well, it's not about chasing the hottest new tech or the biggest dividend yield today. Nope. The article says it's something way more basic, something that guarantees a company's still going to be around to send you those checks year in and year out. And that one thing? It's longevity. Simple, right? But it's so important. I mean, the article puts it perfectly. Nobody cares about a high yield if the company won't be around in a decade or two. That really hits the nail on the head. We're not looking for a flash in the pan. We need a company that has proven it can take a punch and keep on going. All right, so with longevity as our North Star, the article zooms in on one company in particular. It's a tech giant, a name you've probably known your whole life. A company so iconic, it's got a nickname. Big Blue. Yep, you guessed it, IBM. And I can almost hear some of you now, IBM? Really? Isn't that, kind of old news? But hang on, because the case the article makes is actually pretty compelling. It might just convince you that this old school titan is the perfect long-term play. So the whole argument for IBM really stands on 3 big pillars. First, this company has been around for over a century. Second, it's like a corporate chameleon. It just keeps changing and adapting. And third, they have a rock-solid history of paying their shareholders. Let's dig into that second point first, this whole idea of reinvention. So how in the world does a company that was founded way back in 1911 manage to stay relevant in today's tech scene? Simple, by refusing to stay the same. Honestly, the story of IBM is basically a textbook on how to evolve. Just look at this timeline. It's wild when you see it laid out like this. We're talking about a company that started with tabulating machines, think mechanical calculators, back in 1911. Then they basically owned the 60s with mainframe computers. In 81, they helped kick off the personal computer revolution. And remember when Deep Blue beat the world chess champion back in 97? That was IBM making AI a household name. And today, they're all in on quantum computing and the cloud. That's not just surviving, that's leading the charge, again and again. And this really drives the point home. You've got the then versus the now. They went from being all about clunky physical hardware to being a powerhouse in AI, cloud services, and these super advanced quantum computers. It's like they're a totally different company, just wearing the same logo. And guess what? This new focus is working. We're talking about almost $12 billion in free cash flow over the past year. Now, free cash flow is basically the pure profit, the cash left in the bank after all the bills are paid. And that is the engine that lets them pour money into new tech and, most importantly for us, keep those dividend checks coming. Okay, so we've established they're a cash machine. But how does that translate into real money in your pocket over the long haul? Well, this is where the magic of compounding comes in, and the article gives us a fantastic real-world example. All right, let's hop in the time machine for a second. The year is 2005. You've got about $1,000 you want to invest, so you decide to put it all into IBM, and then you just walk away. So back in 2005, your $1,022 gets you some shares, but here's the key. You do one very smart thing. You enroll in what's called a Dividend Reinvestment Plan, or a DRIP. It's super simple. Instead of them mailing you a check for your dividend, that money automatically buys you more shares of IBM, even tiny fractions of shares. It's like a financial snowball, just getting bigger all on its own. Okay, now let's fast forward to today. That little $1,000 investment, it's now worth over $7,400. Now, yeah, the stock price went up, which is great, but the real MVP here, it's that dividend snowball that just kept quietly buying you more and more of the company for 2 decades straight. But wait, this is where it gets really mind-blowing. Your effective dividend yield, the income you're getting based on your original $1,000 investment, is now 17%. Think about that. You're getting 17% of your initial money back every single year just in dividends. That, my friends, is the awesome power of compounding. And even if you're just looking to buy in today, it still looks pretty good. As you can see, IBM's dividend yield is nearly double what you get from the average S&P 500 stock. So, case closed, right? A 100-year-old company that keeps reinventing itself and showers you with cash sounds perfect. But this is where the article pulls a fast one on us. Just when you're sold on the idea, right at the very end of this whole glowing review of IBM, the author throws in a major curveball. It's one of those read the fine print moments that completely reframes everything we just talked about. And here it is, right from the article. The Motley Fool's Stock Advisor analyst team just identified what they believe are the 10 best stocks for investors to buy now. And International Business Machines wasn't one of them. Whoa. So after building this amazing case for IBM, they tell you it's not even on their own best of list. And the reason why? Because that list isn't about slow and steady. It's about chasing monster returns. And when they say monster returns, they're not kidding. We're talking about turning $1,000 into almost $700,000 with Netflix or over $900,000 with Nvidia. So what the article is really doing here is setting up a choice between two totally different investing philosophies: the reliable, slow and steady compounding of a giant like IBM versus trying to catch lightning in a bottle with the next big thing. So let's recap what we've covered here. First, when you're thinking long-term, longevity is everything. Second, old dogs like IBM really can learn new tricks. Third, reinvesting your dividends is like putting your money on hyperdrive. And maybe the biggest takeaway of all, always understand the context of the financial advice you're reading. That fine print is there for a reason. And that really leaves us with the big question, doesn't it? What's the better bet for your money over the next 20 years? Is it the slow, steady, predictable giant? Or do you think the next monster return is out there, just hiding in plain sight, waiting to be found? It's a tough call, and there's really no single right answer.